Okay. The question says that Biashara Limited wishes to invest in stock M and N in different industries. The following information relates to the stocks. So we have expected return, we have standard deviation, we have beta coefficient, amount of money to be invested. When you see the amount of money to be invested, when you're talking about portfolio management, what comes to your mind? When they have given you the amount to be invested under portfolio, like this question is for portfolio theory, what comes to your mind? You should think about weight because they are trying to tell you, yes, Violet, weight, right?
Yes.
Yes, that one they're giving you weight indirectly. So automatically you can know that these guys have given you the weight. So they have given you the weight there, then they are asking you the expected portfolio return. Can somebody tell me where we can start from? I want us to discuss. Where will you start from?
Getting the weights.
After getting the weight, what is the next thing?
You calculate the expected return of
What is the
portfolio.
formula?
The weight times expected return of security.
So expected portfolio return is the weight times the expected return for each, then you add them. Okay, so let's start. Look at that. So the first thing that you need to do is write down the formula. The formula will guide you on what you need to look for. So it is from the formula that you learn that you need the weight. Let's look at the expected return of a portfolio. Expected return, so that is our May 2016, question number 2. Is it 2C? Right? So you say that the expected return of a portfolio is equal to weight of X times expected return of X plus weight of Y times the expected return of Y. So we need the weight. Like in this case now, we need the weight. So weight for M, like in this case now we have M. So you can use the word M here, and then this one's N. N. So weight for N is equal to, we are having 800 N. We have N and M. Weight for M. So for N, for M is 1200 all over the total line. The total is the summation of the two. So that is how much? 2000, right? Or 2 million. And that's will give you 0.6. And then the other one is 800 all over 2 million. That gives you 0.4. So that is the weight. Now, do you have expected return for each? Yes, you've been given expected return for M and also for N. That is 18 and 18 and 16. So you can say now expected return for the portfolio is equal to now 0. We start with the M. M is 0.6 times 18 plus 0.4 times the other one is 16. So what are you getting? And that is what the examiner wanted you to get.
17.2.
17.2. So you're getting 17.2%. Imagine that's what they wanted. That's simple. Now, the second question they're saying, explain the effect on the portfolio if the returns of stock M and N were perfectly positively correlated. Then they are telling you include suitable calculation. They want you to confirm the impact. Now, what do you think will happen if they are perfectly positively correlated? Somebody can help me? So you can say that if, that is from 1 to, say that if returns in the portfolio, if the returns in a portfolio are perfectly correlated, if returns of two stocks in a portfolio, you can say two stocks, if the returns of two stocks in a portfolio are perfectly correlated, if they are perfectly correlated, then the returns are expected to move towards the same direction. That means that if they are increasing, if the return is growing, all of them will have a positive return, or all of them will go down at the same time. So they will move at the same direction. The returns are expected to move in the same direction. Therefore, there is a zero risk reduction. There is a zero risk reduction. There is a zero risk reduction, because if you ikiamua ati una lose, you will lose totally. There's nothing that is going to prevent them, or it is not going to cancel each other. So therefore, if you have to lose, you lose. If you have to lose, you lose, right? So you say that therefore there is zero risk reduction through building such portfolios. There is zero risk reduction through building such portfolios. There is zero risk reduction through building such portfolios. So we are told that we need to now calculate, use a formula to be able to calculate this, right? Normally, if you want to see the change or percentage risk reduction, you remember when we were looking at the percentage change, we're looking at the analysis, or we call them sensitivity analysis. What was the formula? Percentage change was percentage reduction or risk reduction. We want to see whether there is a percentage of risk that is going to reduce by the fact that we have the portfolio. So the percentage risk reduction should be equal to, we have the weighted risk of the portfolio minus the actual risk all over actual risk. What were we doing? We used to say new minus all over old. So new minus all over old. So we want to see the percentage by the fact that now we have weighted, by the fact that we have formed a portfolio. Initially, there was the risk that was there, which is the old risk. But now, after forming a portfolio, which it happens that they're the same, we have now gotten a new one. So we want to see the new risk minus the old risk all over old risk. What is the percentage change? Is it going to reduce or is it going to increase? So that is the percentage risk reduction. That is the percentage risk reduction. Now, how do we get the weighted risk? Weighted risk of the portfolio. Who can tell me how we can get weighted risk of the portfolio? Anything that is weighted, what do you think? Is weight times risk of the first one. It is the weight of M times the risk of M plus weight of N times risk of N. That is why it is called weighted. So you add this. So how do we get that? What was the amount of risk? What was the amount of risk for M? Are we given? That is now what we call weighted risk. Amount of risk in M, standard deviation, we are given 8 and 6. So we can be able to weight them, 8 and 6. So weighted risk here is 0.6 times 8, and then plus 0.4 times 6. So what is the weighted risk? Weighted risk. Weighted risk. What is the weighted risk? Higher.
7.2.
7.2. Thank you. 7.2. So we are saying that if they are moving to the same direction, then the race and the weight on that race, you just add with the race and the weight of the other race. They don't cancel each other. It's just the summation. You add the total. Ni kama hii inaenda kwa hii same direction, you add the ingine. They don't go to opposite direction. So if that is now the weighted average race that we're going to have, like the main race for the two, the main race for the two, now that they're going to the same direction, we can be able to compare it with actual race. You know how to calculate the actual race for the portfolio. So we have two types of race that you can calculate. There is a weighted race that now you know, and then there is actual race that you can be able to get when you have the portfolio. Now we want to see the differences. Now, what is the actual risk? How do you calculate it? Risk of a portfolio. The actual risk of the portfolio. Want to see if they are the same. If they are the same, then there is no zero. There is zero reduction. We say that risk of a portfolio is equal to, what did you say? Weight of M times, check your formulas. Check your formulas. So it is
Weight of M squared times the risk of M squared plus the weight of N squared plus the risk of N squared plus 2 covariance XY plus weight of,
now you say MN.
oh, sorry, MN times weight of N and weight of Y. Weight of N, sorry.
So that's the formula. Now this formula is for getting the actual risk, not weighted risk. So we have two types of risk. Listen again, we have two types of risk. The one that they will normally ask you is the actual risk. But now when they're moving to the same direction, like in this case, we have weighted risk. Now this is the actual risk. So can somebody now help me get this? So we have here, what was the weight? 0.6 squared times, what was the risk here? We're having 8 squared plus 0.4 squared times 6 squared plus 2. Do we have covariance? Are we given covariance? Huh?
No.
So we need to calculate covariance. They are saying that when items are moving or they are perfectly correlated, they are saying that they are perfectly correlated. What is that? When they are positively correlated, when the M and N were perfectly positively correlated, then what happens? The coefficient of correlation is 1. That is perfectly positively correlated. Perfectly positively or positive correlation has got coefficient of 1. So if it is perfectly negative correlated, the coefficient is normally -1. But this one is +1 because they are going to the same direction. They are going to the same direction. Is now +1. Now, if that is the case, so that means that the coefficient of correlation between these two items is 1, is equal to 1. Coefficient of correlation between perfectly correlated securities in a portfolio is 1. So what is the formula? What is the relationship between coefficient correlation? The relationship between coefficient correlation and covariance. R is normally, R of Mn is normally covariance of Mn all over. Check your formula. Where R means correlation coefficient, so we normally say that correlation coefficient, which is now 1, is equal to covariance of Mn all over risk of
Standard deviation of M and standard deviation of N.
If that's the case, then what is the covariance now? So covariance of Mn is equal to multiply this. So we have R, that is correlation coefficient, times standard deviation of M times standard deviation of N. But this one is 1. It's 1. So it's 1 times, what is the standard deviation for M? Is 8 times, this one is 6. So therefore, our covariance, which we shall use there, is 48. That is how you get the covariance. If they are perfectly correlated, then coefficient is 1. If they are perfectly correlated, perfectly positively correlated, perfect positive correlation coefficient is 1. So we can now be able to have our covariance. So that is times 48 times the weight is 0.6 times 0.4, and you're done. So this is now where the examiner was testing you, so that they check if you can remember this formula, and if you know that a perfectly correlated, perfectly positive correlated securities have got a coefficient of 1. So what are we getting here? This is going to be 0.36 times 0.64 plus 0.16 times, no, this one is 68, 64 times 36 plus, this one is 96 plus 0.24. Is it true? 0.6 times 0.1. Yes. So we shall have this 0.36 times 64. We have 23.04 plus 6 times 6, 5.76 plus, this one should be times times 6, 3.04. So that is 51.84. So that is what we are getting, 51.84. The square root of this, so that we can get the risk. Are we together? So that means that the weighted, remember the weighted was 7.2, and the actual is also now 7.2. So our percentage risk reduction is equal to 7.2, which is the weighted minus the calculated, which is the actual 7.2, lower 7.2. The answer is 0. So that means that there's no risk that you're reducing if you have items that move towards the same direction. And so they told you to confirm using calculations. So that is what you have just confirmed. You confirm to them there is no much difference. If they were not moving to the same direction, then there will be difference. The reason why there will be difference, the coefficient correlation will not be 1. This one has come up because coefficient correlation is 1, because they are perfectly positively correlated. If they were not perfectly positively correlated, it means that when one makes a profit, another one makes losses, then the coefficient correlation will be a different figure, which is not 1. And that is now what we would have created the difference. Now, instead of multiplying 1 times 8 times 6 the way you did, you'll have a different figure, probably 0.4 times 8 times 6, where you're not going to get 7.2 or 72, right? At the end of the day, that is not the figure that you're going to have, which has got 72 as the implication, because that one, the 72 came, how much was it? It was no, 48. You are having 48. You'll be having a different figure here, which is not 48, if they are not perfectly correlated. So if you have a different figure here, which is not 48, then that means that the result here will not be 72. Tunaelewana? This is where the coefficient correlation had got implication. When we are getting covariance, we use coefficient correlation figure, which is 1. That coefficient, if it was a figure that is different from 1, means that our answer would have not been 72. And that would have actually got the whole difference. So you have seen the trick there. Master it well. Let's look at now the next part. What about this one, Mapeni? So the examiner is saying that Mapeni investment funds comprises 4 major projects. The details of the projects are as follows. So we have the market value, we have expected return, we have standard deviation, we have coefficient correlation with the market. Coefficient correlation with the market. So we have projects here, project 1, project 2, project 3. Then we are told the risk-free rate is 5% and the market return is 14. The standard deviation of the market is also given here. They require the beta coefficient of the investment fund. Beta coefficient of the investment fund. So where do you start from? Where do you start from? Tunafanya revision na tunaelelea tu vizuri. That is how revision is done. We have covered, we have the content. Now the thing is, we need to apply them in different ways and see how examiner can be able to play with our mind. It also helps us to revise and remind ourselves what we studied in the previous classes. So where do we start from? Somebody to guide me. Assuming ungepewa hiyo by exams, assuming that you're given that in exams, where will you start from? The beta coefficient of the investment. The first thing that you always remember is to write down the formula. Write down the formula. Write down the formula. So what is the formula for getting a beta coefficient of an investment or a security? We call it B. Yeah, so this one is question number, the same here, but now B, right? The same setting, but question number B. Formulas for getting the beta coefficient is, who can remind me? We learned about this. There are two formulas. The first one is, check your notes. Remember what we said, that covariance of Mn over risk of M times the risk of N is equals to correlation of Mn. I need you to get used to these formulas. So that means that whenever you're applying covariance, you can apply correlation. Just need to represent this so that we have covariance being Mn being correlation of Mn times risk of N times risk of N. Still rise. So whenever you're supposed to have covariance, you can always replace them with the correlation if you're given correlation. Now, the formula that we're given, you can always remember that. What were we given? that this one is the same as covariance of J and the market all over risk of the market squared. Is that true?
Yes.
Risk of the market squared. So risk of the market squared is the same as risk of the market times risk of the market. Sindio? Sindio? So we are comparing, for us to get the risk better, we were comparing the risk of the item and the market. Even the formula was beta J all over beta market. So for beta, we normally compare them with the market. So that is why the examiner has given you the correlation coefficient with the market, because they know that anything to do with beta, you're supposed to compare with market. So that's why the formula looks like that. So now, assuming that that market is also an asset or a security that you're now comparing with, then you will say that now our covariance of, let's pick one of them. So we have one there. We have the first one there. We'll say that for asset one, beta for asset one is equal to covariance of asset one and the market all over market times market. Siko hivyo. We take one, the asset number one. So we say that for asset number one, we are comparing it to the market. So covariance of asset one and the market is equal to, this one is the same as the risk of the market squared. Risk of the market squared. So this one is the same as, let's now have covariance to be represented in the form of correlation. What is this in terms of correlation? Covariance of IM is equal to correlation of IM times, can somebody tell me? Times the risk of I times the risk of the market. Because we are looking at risk of I or one. Let me call it now one. And then also risk of one and risk of the market. So therefore we can come and now replace this. Covariance of investment one, which is now this one, and the market is the same as correlation between investment one and market times the risk of investment one times the risk of the market, all over risk of the market times risk of the market, which is risk of the market squared. This one, risk of the market squared. So this one has been represented like that. Are you missing it anywhere? Is there any person who is getting confused? If this formula makes sense for you, then even this one, when you now come and replace J with asset one, then this should also make sense. Is it making sense? Or we are getting confused somewhere?
It's making sense.
Can somebody tell me where you're getting confused? Sign, pay. Ordinarily, covariance, we normally compare covariance of two securities. How do we write them? We say covariance of X, Y. What about, so that is between X and Y. What about if you're given asset one and market? So you just have covariance of asset one and market, just the same way. And if covariance of XY is equal to correlation of XY times risk of X, risk of Y, then why can't you have correlation of asset one and the market times the risk of asset one and the risk of the market? Because you are basically replacing them. And that is why I'm saying it should make sense to you. Now, if it does, then remember that this one we have just broken it into risk of the market times risk of the market, which is the same as the risk of the market squared. And now because we have risk of the market here, we can cancel these and these. That is mathematical, right? is allowed. So what are we going to have? We are going to have our correlation of asset one and the market times risk of asset one or lower risk of the market. Because we only remain with this. This is cancel this. So therefore, we can have our formula like that. So we've learned that we can get this in two ways. We can use either this formula or this. When you're using relation, you can use this. And when you're using covariance, you can use this. So either use covariance. So for this one is now Bj or B of asset one. You can use this formula when you're using covariance. This one when you're using covariance and then correlation. What are you having in your notes as the formula? Can somebody confirm for me? For correlation, what was the formula? Check. Is it coming to something like this or closer to this? Read the formula. We are basically driving the formula.
Yes, it is.
It is. Thank you.
Yes.
It is. Thank you. Now, depending on what the examiner has given you, you now need to get your beta coefficient. Then you ask yourself, what am I having? Am I having the covariance or I have correlation? If you have correlation, go for this. If you have covariance, go for this. So let's see what the examiner has given us. The examiner has given us coefficient correlation. There is no covariance. So automatically, you can't waste your time using covariance. Automatically, you can't waste our time using covariance. So if that is the case, we can now get the beta for all these projects. We can get for the 3 projects. How many marks are we given? 4, because there are 4. So kila moja ni 1 mark. Examiner is doing that because they know that you only need to know this formula and then the rest will flow. So hiyo ni marks moja tu. Mark moja tu. So let's now get our betas. So we can start with beta 1, which we say is correlation between 1 and the market times risk of the security all over risk of the market. And that will give you, let me see the figures. So we have correlation is 0.55. That is the first one. So it is 0.55 times 15. That is the risk of the project. All over risk of the market you are given us. The standard deviation of the market is 13. So we have 0.55 times 15 all over 13. Are we together? Risk of the market is given as 13. That is the standard deviation. And then risk of the security, standard deviation for all the securities are given here. So the first one is 15. So we can confidently say that B1 is now 0.55 times 15 all over 13. Get your answer there. Then the same way we come to B2. B2, we are now flowing. We can now flow because we know what we are doing. So we have 0.7775 times 20 all over 13. Kila kitu is over 13 now. So 0.75 times 20 all over 13. Then this one is B3. 0.84 times 14 all over 13. Sasa umeona kwa nini umepewa 1 mark? Because examiners anajua hii ni rahisi. That's 14, yeah? So 0.84 times 14 all over 13. Sindio? 0.84 times 14 all over 13. Then the last one, I hope you are giving me the answers, please. The last one is 0.62 times 18 all over 13. 0.62. So that is B4 is equal to 0.62 times 18 all over 13. Give me the answers, please. That is all that you are required to do. That is all that you are required to do. Now, the second question, can you show the answers? They are saying that by comparing the expected return and the required return. Are you listening? By comparing the expected return and the required return, advise whether Mapeli Limited should change the composition of its portfolio. Why will you change portfolio composition? Portfolio is composed of securities. And if you have a perfect portfolio that is made up of blue chip companies, any companies that securities are doing well, you will not want to change them. Sometimes we normally have portfolios so that we can be able to gain more. If you have portfolios from different companies, but they are doing well, we call them blue chip company. And that is what you wrote in your first sentence in this topic. That perfect portfolios are made up of blue chip companies. Blue chip companies are a company that is doing well. If they are doing well, we are going to have a perfect portfolio, then you will not want to change them. But now, when you realize that one of the securities, yani umeweka, for example, umeweka portfolio yako iko na KCB, iko na Equity, alafu, or KCB and Equity, those are perfectly correlated. They are in the same industry. So that one is not a very good portfolio. That is an example of the perfectly correlated portfolio, Equity and KCB. Why? Because all of them are in the same industry. They can make profit at the same time and go back at the same time. Because if banking industry is doing well, all of them will do well. If the rates are down, they will all go down. So that is not a good investment. Invest in Safaricom or tourism industry, and then you invest in banking industry. If all of them are doing well, they are good because we will not be meeting. But if they are going to be in the same industry, if they are going to be in different industry, but moving towards the same direction, we can say that they are positively correlated, but they are not perfect. Unaweza kupata industry that are behaving the same way. Kama tourism industry and hotel, they are not in the same industry, but they are positively correlated. They are not perfect, but positively correlated. So that one will be having a positive figure, but not 1. It can be 0, 0.5, 0.9, but not 1. So those ones are better. But now the best one is where when one goes up, another one goes down. That is now perfectly but negatively correlated. Perfectly but negatively correlated. Those are good investment. So that when you're making losses in one, you make a gain on one, and the net effect is 0. You're not making any risk. We are saying that you have reduced risk 100%. Hakuna risk unaika, zina cancel each other. Now, the examiner is now asking you that you have these two industries, the two shares or two securities that you want to ask yourself in the basket, which we call portfolio, in that basket, one of them is not perfect. One of them is doing poorly, but another one is doing well in that portfolio. As an investor, you'll want to take away the one that is not doing well. Sindio? Hautaki in your portfolio, the one that is rotten, the one that is making you have a loss. Inafaa utoe, sindio? So how will you know the one that is not doing well? Or what formula are you going to use to know that this one is not making profit, this one is making profit? Which formula is that? So examiner is asking you for what? Can somebody tell me what the examiner is testing? Can somebody tell me what the examiner is testing? Violet. Examiner anajaribu kutest nini? Kama umenielewa vizuri. In this portfolio. Sally. Anajaribu kuuliza nini? We have learned about this. We just learned it the other day. The examiner is asking for profitability index. Which one is not making profit? You have so many shares, but one is making losses. The one that is making losses unatoa from your basket. So comparing the expected return and the required return, which formula compares expected return and required return? Required return is the CAPM, is the CML. Expected return is ERS or ERJ. So if you're told, determine the required return using CAPM, determine required return using CML, those are required returns. So which formula compares the two? Jensen alpha. It is Jensen alpha that compares expected return and the required return. And in that case, required return, we normally call it either CAPM if you're using beta, and we are calling it CML if you're using standard deviation. Again, it is going to help us to know the profitability. Through the profitability, we'll be able to know which project is not doing well, alafu tunatoa from our basket. So it is the one that will change. We'll tell them, toa hii, weka hii. Ama reduce this amount, increase the one that is doing well. That is how you can change. You know, sometimes you cannot be able to remove it completely. You only have to diversify, and the only options that you have are two. So what you say, reduce, you only have two assets in your portfolio. So nawambia, punguza hii yenye na make losses, punguza, invest maybe 5%. The one that is making profit, ongeza ikwe 80%. So we are saying, you are trying to change the composition or proportion. You're going to change the proportion, and that is what they are testing here. Look at the question. After knowing the one that is making profit and the one that is making loss, they're comparing the expected return and the required return. Advise whether Mapeni Limited should change the composition of its portfolio. So if the portfolio is composed of 80% of A and 20% of N, you may realize N is not making profit. Now, ongeza hiyo ingine pale, you are changing the composition. Okay, so now that you understand this, Kwanza, have you gotten for me these ones? Betas. They are very important that you give me the betas. Because those are what is, these betas are the ones that will help you now calculate the CAPM. So najua formula ya CAPM beta inatakikana. Sasa ukinyamaza, tutapata aje CAPM? You have to give me the figures. You have to give me the figures so that we can be able to calculate CAPM for each, and then we use that CAPM to compare with the expected return for each, which we are given. Then we tell them whether they are profitable or not, whether they are efficient or super or inefficient. Give me those figures. Mmenyamaza sana. Give me those figures for CAPM, for beta.
The first one, 0.6346.
Thank you.
1.15.
Unasoma at the same time. I have faith soma hiyo. Sally, unasoma the next one.
Okay, 1.1538.
1.1538. Okay, Sally.
0.9046.
0.9046. Violet, give me the last one.
0.8585.
0.8585. Now, if you are very keen, you'll realize that examiners are very good people. They set a question that if you answer Roman 1, the answers in Roman 1 will help you to solve answers in Roman 2. Now they are asking us to calculate CAPM indirectly, but they call it required return. For you to get the CAPM, you have to get the beta for each asset. And for you to get the beta, you must have gone through this, all that struggle. And that is how the examiners start moving your way. Now, when we are marking, and I did tell you guys, I also mark papers. So when we are marking, everybody's at 100%. You go to question number 1, unaanza kupunguza. Ukipata wrong, unabaki 98, 97, 95. Hivyo. So unapata, mwingine alishindwa from here. Yeye from the start, haku make any step. Unajua sasa huyo hata haizi guza hizi mpaka mwisho. Hawezi, because hajui kwamba we have two ways of calculating beta. And if you can't get your beta, I'm telling you Roman number 2 is not there. And that is how many marks? 10 marks imeenda. So wewe kama na mark paper yako, from 100 natoa 10, tunafika 90. We are going to Oman 2 or question number 2. Tena question number 2 pia, tunakufanya hivi kidogo, ushatoka for life. And that is what examiners are doing. So we have to get this right so that it can help us to move to the next stage. Now, next semester, I want one of you to come and assist me, teacher FM. Okay, so what did we say? Now we have the figures here. And the first one, second, doing well. Okay, up to the last one. Fine. Now the next part is now to get what? Do we have expected return? Expected return tumepewa. So hiyo tuko sawa. Expected return ndio easy. So we need to calculate our is it for the portfolio or for each asset? We can calculate for each asset and for portfolio. How do we get return now? A required return for a portfolio. We use CAPM. Required return, underline that. For required return, use CAPM or CML. So what is the formula for CAPM? Can somebody tell me?
Risk-free.
Huh?
Risk-free rate plus ERM minus risk-free times beta.
So CAPM return is equal to risk-free rate plus ERM minus RF times beta. So let's come to the first one. So for 1, we're going to have, are we given the expected return? The risk rate, tumepewa ni ngapi? 5. And then market is 14. 14, eh? And then beta we have calculated. So we are good. We are good. So we can be able to get our 5% plus 14 minus 5 times, for the first one is 0.6346. Get me the answer. Then for asset number 2, we're going to have 5 plus 14 minus 5 times 1.1538. Get me the answer. Then we come to asset 3. We have 5 plus 14 minus 5 times 0.9046. Then we have R4, 5 to 14 minus 5 times 585. Okay, so we need to get those CAPM returns. And now we come to the next part where we're going to talk about the alpha value. So alpha value of securities, because these are securities that forms a portfolio. So the one that is not okay to Tatoa, the one that is inefficient, we just tell them replace this or remove. So securities in this portfolio, the first one is we just say the formula is equal to expected return of S minus CAPM return of S. So for the first one, we'll say, what is the expected return? I'm hoping that you're giving me CAPM return, by the way. Expected return is 10. So we have 10, 18, 15, 13. So we have 10. Then we have 2. So we have 10, 18, then 13, 15. Then we have 13. Can you give me the figures, guys? Yeah, kwanza ni nini?
10.7114.
9 times this plus this. Unapata? The first one is
7114.
10.7114. Uko sure? Be accurate.
Yes.
Very accurate. So the second one is
15.3842.
15.42.
3842. The third one is 13.41 1414. Sorry, 1414.
14.
Yes.
Huh?
12.7265.
Give me the figures. Tell me, is it perfect or it is imperfect? Is it how do you call it? Efficient, inefficient, or super? This one. Then here we have. Give me the conclusion. Check your notes. The examiners knows what they're doing. So your portfolio is composed of this. Do you want to change anything there? Give me the figures. Are they perfect, imperfect, or whatever? You guys. You're letting me down, imagine. Unaniangusha.
Let me try. We said if the alpha values are negative, it's inefficient. And then positive ones are super efficient and 0 is efficient.
What is super efficient? What did you say about super efficient?
The positive ones, when the alpha values are positive.
What does that mean? There's something that we mentioned. We said that that means that assets are undervalued.
Undervalued.
They are making profit. And I gave example. Ukienda na ng'ombe sokoni, unasema hii ng'ombe yangu mimi nitauza 10,000. Lakini the reality, the price that is required in the market price is lower than that. That means that you overvalue, uli exaggerate. The one that you expected, uli exaggerate. So that is why we are now saying that we are telling you that you're making losses. So it was overvalued, you overvalued it. So you can't make profit. But we are saying that when you see it is positive, we are saying that it is undervalued. What the price that you gave was a price that is lower, and that so you're making profit. So for the ones that are positive, negative, they are inefficient. These are assets that are making losses. These are positive, they are super, meaning that you're making profit. If it is zero, then it is efficient. Now, examiner was trying to ask you that in your portfolio, you have these assets, making a portfolio. You will realize that the three are okay, making profit, but one is not making profit. Sasa nakuuliza, how can you advise the management? Should they change their composition? Ama waachilie vile iko, waache tu vile iko? What is your opinion? Should they let it remain like this, or they should change any asset? Watoe moja, ama wa reduce investment? So the conclusion is, because we can see that these are making more profit, this one is positive 2, this is positive 3, this one, you can tell them that generally the portfolio is making profit, because you can see when you add this, you'll have a positive figure. So when you add these 3, even if you weigh them, you're going to make a profit. So unaona, the portfolios, this is the only negative, the rest are positive. So if you add all this, the result effect is that you're going to make profit. But it's not the profit that you should have made, because there's one that is making you have losses. So you can advise them that securities have got positive values, i.e. they are profitable. However, the management needs to acquire more of 2 and 3, because 2 and 3 are positive, higher positive. So they need to acquire and invest in more of this, and reduce the investment in one, because one is overvalued, hence makes losses. One is overvalued, which makes losses. So they need to acquire more shares on this. The ones that are making profits, they need to acquire more shares on them. The one that is making losses, they need to reduce. The same thing has been said in November 2016, and let me show you. I will not be surprised if ikikuja kwa mtihani. Nataka muive vizuri na msiogope hii FM paper. Naona hii Mary Chege. Wanasema Mary Chege has been investing in the shares of, this is now 2016 November. Question number 2. It is normally question number 2. Mary Chege has been investing in the shares of various companies quoted in Securities Exchange. Currently, she holds a portfolio shares in 4 companies, XYZ, WXYZ. They have given you the number of shares, equity, market price, expected return. Let me ask you, when you're given the number of shares and they're giving you the market price, what is the examiner giving you? Kiona amekupea hapo number of shares and the market price per share. Anajaribu kukuambia nini?
We calculate the total value of shares.
Total value of shares, and therefore you can get what? The weight.
The weight.
Thank you. Now, look at Roman number 2. Determine or determine. Okay, determine whether Mary Chege should change the composition of her portfolio. Is it not the same as what we did? So once they have told you to advise whether we should change the composition, that person is telling you to look at the profitability of each investment. And then you advise. 2 marks. Huyu naye alikuwa na roho mbaya aje. Marks kadogo hivyo, 2 marks, and there are 4. Okay, so that is total of 6 marks. Anyway, it is better than nothing, sindio? Kwa mtihani hiyo ni mingi. Portfolio risk, we have a correlation coefficient of their companies, then portfolio risk assuming equal weight. correlation coefficient huwezi kosa kufanya, ndio? Hii ni rahisi. But wacha tuone hii kwanza ya Merichebe. So the first thing is that they're telling you that the current market is given as 14, that is ERM 14%. The treasury bill, that is the risk-free rate, ndio, is given as 9%. The risk the risk of Merichege's portfolio relative to that of the market. The risk of Merichege's portfolio relative to that of the market. Okay, so if you were me or I were you, where will you start from? In Merichege. So, where will you start
We
from?
calculate the weights.
Good. Start with what you can. You know, you're coming to portfolio. So, the first thing that it should have given you the weight. So, you start by calculating the weight. They're telling you the risk of Merichege's portfolio relative to that of the market. And they have given you the equity beta. They have given you expected return as well. So, that is November 2016. Question number 2. Is it C? Wamezoea C or B, C or B. So the first thing, common one, determine the weight of the securities. So the first thing that we'll do, get the weight of the security. How do we get it? We'll take 10 times 130 for X, and then like that. So let's get for X. We have 10,000. Is it 1,000? No? Yes. Times 130. That will give you a total of. And then we have X. We have 15. You can read for me. 15 point times 100. Then we have Y. 15 times 90. So that is so I can't calculate 15.9. And if 15 times 90, I don't know, but 15 times 100, I know. Is it normal? Then the last one is 10 times 160. Sasa wenzangu, ukipata mahali kama hapa, usiogope hata kidogo. Anzia mahali unaelewa, alafu zingine zitakuja. So hapa, we can be able to get a total. So the total there, then it looks like 290. This and this is 290, 2.9. 2.9 and this one is 2.85. So 2.9 plus 2.85, 57.50. So our weight, we have weight for Y, W, sorry, is 130, 13 over 5. Times 100. Then weight for X. We have 15 over 575 times 100. Then we have weight for y is equal to 1350 over 5750 times 100. And then we have z, which is 1300 over should we even have times 100? That will make it percentage. Let's leave it pure weight equal without having percentage. Let's just have them.
The last one is 1600, not 1300.
Oh, 1600. Eh? Let's just have them like that without having percentage. So 1300.
I have the answer.
0.23.
0.23,
0.23.
0.26, 0.23, and 0.28.
So when you add all this, they should give you 100. Is it going to give you 1.00?
Yes.
Good. So that is the first step. We have our weight. We have our weight. Now, beta of the portfolio can be weighted. Beta of the portfolio we can weigh. Remember how we did it? How did we get the weighted beta of the portfolio?
The weight times beta of the security.
Of each security, then you add them still.
Yes.
They're asking you risk of Merichek's portfolio relative to that of the market. So the risk of the portfolio here can be able to now get you can now have weight. So beta of the portfolio you can get us or weighted beta, weighted risk the portfolio is now 0.23 times what is the risk on the first one? 1.12. 1.12. Plus 4. So we have 0.26 times 0.89 plus 0.23 times 0.7 and then plus 0.28 times 1.6. What are you getting? As a beta of portfolio or the risk in this case? Let's take your calculator.
1.098.
1.098.
98.
What is the market beta? Is normally market beta is
1.
1. So they are telling you that now compare the beta of the portfolio, which is this, and the beta of the market. How do you compare the two? The risk of portfolio relative to that of the market. Basically, the answer you've gotten here. But then you can now explain that the risk of portfolio is higher than the risk of the market because it is more than 1. You can explain. Since the risk of the market is always 1, the risk of the portfolio is higher because it's 1.098. That is what they wanted you to get. 4 marks. Just get the weight, and then you weigh, get your weight of the portfolio. Now, I want you to remember something. There is a beta of the portfolio that you get through this formula. And then there is beta of the security, which you get through using covariance or correlation. So don't confuse the two. Utafika kumtihani ushangae. Hapa niliona Mr. Dennis alikuwa anatumia hii. Lakini mbona hii sasa hivi? Beta for security, here we have been given 1.1. We are assuming that for them to reach here, they used either covariance or coefficient. We don't know those figures. They have done them for us. So those are beta for securities. For the portfolio, it is just the weight times the beta of the asset plus weight times the beta of the asset. Then you have a total. That total you can compare with the market. Market is normally 1. Now, you've been asked to now get comparison because they are telling you in relation to the market. You say that the risk of the portfolio or risk of the portfolio is higher than that of the market since the market is only 1. Let's get the second question. Determine whether Mary Njoroge should change the composition of the portfolio. How do we know that portfolio should be changed? Can somebody tell me? In fact, if you want to even prove to them, start by saying Roman 2. Then you say that securities with positive alpha values, are profitable and undervalued. While securities with negative alpha values are loss-making, and overvalued. Overvalued are making losses, overvalued. Hence, should be replaced. So in terms of investing in them, now start. Then you can now get expected return. The expected return, no, required return is equal to RF. You're using CAPM, of course, because you have seen kuna beta. ERM minus RF beta. So we start with the first one. We have Y, X, and then W, X, Y, Z. So we have that. RF should be constant. Risk period do not change. It is also called treasury bills. That is 9. So we have 9. ERM is this. The rest are now given. We have this. Examine amekupea kila kitu. So we shall have RF, which is 9 plus 14 minus 9 times 9 plus 14 minus 9 times 9 plus 14 minus 9 times 9 and plus, sorry, these are plus. 14 minus 9 times. Those figures are going to be given here. Only that I forgot them. Can't remember. So I just align them here. We have 1.12. We have 0.89, sorry, 89. Then we have 0.70. Then we have 1.60. 1.60. India, ya chini. You can give me the answers. So E, 5. So all of them, just say 5 times 1.12 plus 5 plus 9. So this one gives you 14.6.
13.43.
13.43.
12.5. And 17.
17.
Yes.
0. So now those are required terms. And because we are told to compare, so that we have to get profitability index of each and advise, allow me to have here. Allow me to have here. So that we say that our profitability index for W is equal to, in fact, you can say profitability index of a security is equal to expected return minus campaign return of the security, right? That is it. So we have expected return. Do you have expected return? Examiner has given us here. Expected return 18. So we have for W, we have for X, we have for Y, we have for Z. So the first one is 18. The second one is 23. The third one is 11 and 17. 11 and 17. Then you now have to minus. Now your minus what? What you are given. Down here we have calculated 14.6. Here we have 13.43. Then we have 12.5. Then we have 17.0. Now this one looks like 3.4. This one, I don't know. That one I can't calculate really. This one looks like 10 point. Not really 10 point, I don't know.
The first one is 4.6.
4.6.
Yes. 18 minus 14 is 4.
18
The
minus
first one.
18 minus 14.6.
Yes, it is 4.6.
Oh, really? Okay. 4.6. I need to try that. 18 minus 14.6.
It's 3.4.
4.
Yes.
Oh, sorry. It is 3.4.
23 minus 13.43. So this one is 9.57. This one is 11 minus 12.5. Hawa ni majanja, lazima wakupee moja that is inefficient. Kama sasa hiyo tumepewa is inefficient. And then here 0. This one is efficient. Kwa examiner ako sawa. Sana kwambia hii ni super efficient. This one is, and I want you to do for them like this in class so that you can prove to them that you went to school, right? You were taught well, eh? This one is inefficient. Sio watu wengi wataweza hii. I'm telling you here. Efficient. So this one is correctly valued. Eh? This one is over valued. This one is under. Under is the one that is good, undervalued. They're making profits. These ones are also undervalued. Now they're telling you to advise them whether Mary Chege should actually change. The one that is correctly valued, not much, but this one is a problem, is loss. So you can say that Mary Chege should invest more in asset W and X and reduce investment in Y. Is it a difficult thing to do? Is it something that is difficult?
No.
Not really. That's how efficiency works. So in exam, they will tell you, tell us about efficiency. Now, I'll not do this example, but now I just want to open your eyes and show you what they have done of late. Sally, are we together?
Yes,
We are not.
we are.
We are. I. So, which sitting is that? Where there? This one is from 2023 December. Sorry. Okay, no problem. So in 2023 December, then August. So this one we agreed we can disappear with this. They are saying that Simon Kobia, an investor, is evaluating 6 portfolios with the following characteristics: expected return, standard deviation. The expected return of the market is given with accompanying standard deviation of the market as well. The risk free rate is given using CAPM, using capital market line, CML. Is this better or this one is portfolio? Using CML, advise the investor on which portfolio is inefficient, efficient, or super efficient. Is this CAPM or portfolio? Nini, is this portfolio or CAPM here? Which one are they setting here? Huh?
Portfolio.
They are setting portfolio, not CAPM, because you've seen CML. Tell me how you can get required return, because here you are also going to get inefficient, efficient, or super. So it means that you're going to use the formula for alpha value to compare and tell us, just the same way we have done this. So tell me how you're going to get required return using, because that is now the difficult part, required return using CML. CML return, the formula is, nasikia mtu anafungua kitabu, it is a good thing, fungua haraka haraka. CML return, ni? Check. That is what they are setting now. So don't confuse CML return and CAPM return. Both of them will help you to get the efficient or whatever, the way you have done. But don't confuse the two. I told you that this one we are not going to do, but you need to. And the first question they are asking, analyze 5 differences between portfolio theory and CAPM. Do you know the differences? Did I give you the differences? Differences between portfolio and CAPM. That one you can try to look at. The next question was which year? I just need you to open your eyes and start revising because we don't have much time. Question number 2. This one. Hapo waleta NPV? No. Using the discounted cash flow, analyze the value of ABC. Can we do that? Again, this one, not question number 2, question number 1. Felix Bodo has collected the following information relating to pro forma financial statement of ABC, a company that is a target of its competitors. So we have the normal income statement. This is just a normal income statement with the profit here. So, but for different years. Now, selected pro forma statement, financial statement, has also been given here. They only have change in deferred tax, one asset ingine. Then we have the selected pro forma cash flow. They have given you that. ABC as a company, ABC Limited has a corporate tax of 30%. The weighted average cost of capital is that the terminal growth rate is determined using a discounted cash flow analysis of the value of the ABC. Oh, this one is topic number 3. Value of the firm. We shall be able to calculate that. Value of the firm with the growth rate. That is the next topic we shall start tomorrow. So, hiyo bado kidogo. Hii tulifanya. You have been appointed as finance manager of Mamba Limited after evaluating the investment portfolio of the company. You have decided the company, you have divided the company into 4 portfolios following 2 dimensions, value, growth, and small, large. You remember the value, growth, small, and large. Which one was that? Huh? Where did you get these ones? On your notes, kuna zile other methods of valuing the firm that we talked about. We talked about APT. We talked about, which one again?
Farmer French.
Farmer French. We talked about Pasta, Stan, Bro. And I need you to remember those ones. Using the arbitrage pricing model, determine the portfolio that has got the highest expected return. So we have the weight sensitivity factor. Sensitivity factor, I said that, what is it? What did we say as the sensitivity factor?
Risk.
Is the risk, which is measured in beta. And then we have sensitivity factor 2. So this one is against the market. No. This one is for the market. This one is the price, average, capital. And then now we have the risk premium being given there. The risk credit is given there. They are asking, using the arbitrage pricing model, determine the portfolio that has the highest expected return. Now, we have been told that these guys have categorized the portfolios like this. So we have, these are called portfolios, just like we have X, Y, Z. Now, forget about the other ones, just call this one is X, portfolio X, Y, Z. And these are the weight of the portfolios. So you can get the weight. You are given the risk against the market. Market. These are market betas. Market betas. So you're being told that we have how many factors here? We have 3 factors. Remember, APT was considering more than just the market price. It was considering many factors. Premium has been given. So we have premium against this, for that, plus premium against this, premium against this. And then they're telling, determine the expected highest expected return. Tumeelewa vile tunafanya hii? Take one. APT, we say that it considers several factors. So these are different factors. Factor 1, factor 2, factor 3. And each of them have got a risk premium that is different. They have their own risk premium. So for small, this is a portfolio. For small, you can get APT for small. APT is a multi-factor model. Does not consider one. So APT for small, APT return for S is equal to the risk-free rate, which is RF, plus expected return of the first one minus RF times the beta for the small. But now this one has been given to you, is called risk premium. So they have given you risk premium for the first one plus times beta for the first one. Risk premium for the second one, like that. So therefore, these are the factors. These are the factors. So for small one, we can come and get the first one here. We have sensitivity 0.87 times 8. So that is the first one. So we have R you given us risk period to repair. Risk period is given 3. So we have 3 plus 0.87 times that beta is given us 8 plus the other factor is 0.83 times negative 3 plus 2. Is it 2 or 0.2? 2 times 0.4. 2 times 0.4. And then you get that. That is for small. Then you come to for small growth. So that's small value. This small growth. Then you again do like that. So these are going to be different APTs, and you're going to get their values there, their returns. He's asking you to determine the portfolio that has got the highest return, the expected return. So that is how you can be able to get those ones. All of them. Ni ngumu, sio ngumu, sio? Because unafanya hii utapata. Then you come to this other one, you will do the same. Up to the last one. Then you say which one has got the highest return. The small value, small growth, the one that has got the highest return. So examiner hakuwa mbaya. Then the portfolio that will maximize your return if you decide to use capital asset pricing model. What will be the difference if you're using capital asset pricing model? Then in order to diversify his perceived risk, a competitor wants to find the small value and large portfolios. The new portfolios will have an overall sensitivity factor 1. That is the beta of the market. Beta of the market. So if you're using capital, then you're using the beta of the market. Market beta is given, market beta is given as 1. So the small, not large, not great. So they are trying to get now, when you're now using the weight, you now involve the weight to get the portfolio of the risk of the portfolio, or better of the portfolio. You now use the weight. You now use the weight to get the beta of the portfolio. Determine the portfolio to be invested in the small value and large values. I want you guys to take, because of time, I want you guys to take time and try number 2 and number 3. Then you share on WhatsApp group. We shall get time to go through them and see how you could have handled that. Thus, we only have 3 minutes. We can't be able to finish them. So I want you to try that, then we come and revise together. So we shall start topic number 3 in our next class. The portfolio features required to get minimum risk. This one I told you, this one we did, right? Minimum risk. I told you the formula, how to get the formula. So the rest are okay. You'll try that question, the remaining Roman 1 and Roman 2, and then we shall get time to revise it. Our next class, we shall start topic number 3. Tomorrow. Any question? Okay, if there's no question, then let's stop there. Have a good night. Encourage your colleagues to keep on attending classes. If you are not attending class, I'm so worried. We are almost 10 and only 3 are consistent with class. Have a good night.
Good night.
Good night.